We're jumping straight into Hecla Mining today. Everyone is watching the price action, but the real story is the massive leverage to the silver supercycle and a 67% revenue explosion. The stock is up over 300% in the last year, hitting 52-week highs around, what, $25?
Right around there, yeah.
So the big question we need to answer today is simple. Is this a bubble waiting to pop? Or is this just the start of a grand supercycle for silver?
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds of this massive rally, do us a favor, subscribe and hit the like button.
It really helps.
We're tracking these breakouts every single week, and you don't want to miss the next breakdown. Okay, so let's unpack this. We are looking at Hecla Mining. It is Sunday, January 18, 2026.
And that chart.
The chart is just, if you just glanced at it any time in the last 12 months, honestly, you'd think you were looking at a semiconductor darling or the latest AI startup.
You really would.
You wouldn't guess it's a 135-year-old company that, digs rocks out of the ground.
It really is a standout chart. It defies gravity in a way that boring old industrial stocks usually don't.
Right.
But I think the mistake a lot of retail investors are making right now is just staring at that line going up and assuming it's all hype. To understand why the smart money, the institutional capital, is piling in right now, we have to look past the stock price and look at the engine room. The financials have undergone what we call a step change.
Okay, I hear that term step change thrown around a lot by CEOs who just want to sound important.
Yeah, it gets overused.
But here you're saying this isn't just a gradual improvement or like a lucky quarter.
No, this is structural. It's a completely different level of operation compared to where they were just 2 years ago. If you look at the financials, the transformation is undeniable.
Well, let's talk numbers then. Because transformation sounds nice, but often in the resource sector, that's just code for commodity prices went up.
Fair point.
Is this just a beta trade? Is Hecla just riding the coattails of expensive silver, or is there something actually happening inside the business?
That's the crucial distinction. Let's look at the third quarter of 2025. Revenue hit approximately $410 million.
Okay.
Now, depending on which metric or specific year-over-year comparison you run, that is up roughly 35 to 67%.
Wow, that's a huge range, but either way, it's massive.
It's massive top-line acceleration. Now, to your point, yes, silver prices are up, but if you look at the volume, Hecla is actually moving more metal.
So it's a volume and price multiplier. They aren't just selling the same amount of stuff for more money. They're selling more stuff for more money.
Precisely. It's a dual engine. You have record silver prices, which acts as the tide lifting the boat.
Right.
But you also have higher silver volumes coming online. They are producing more ounces just as the market is essentially shouting, "We will pay anything for silver." That's the sweet spot.
And that flows down to the bottom line.
It really does. They posted a record net income of about $100 million. They beat earnings per share expectations handily, coming in at 15 cents versus the expected 11 cents.
I want to pause on that 4-cent beat. Because I feel like to the average person, 4 cents sounds like, loose change you find in your couch.
Right.
But in the world of quarterly earnings, that's a massive percentage beat, isn't it?
It's huge. It's nearly a 36% beat on expectations. And it demonstrates operating leverage.
Okay.
This is a concept we talk about a lot on this show, but it's vital here. Because Hecla's costs are relatively fixed, it costs roughly the same amount to run the mine regardless of the silver price.
Right. The lights are on, the machines are running.
Yeah, exactly. So every extra dollar the silver price rises, or every extra ounce they squeeze out, flows almost entirely to the bottom line. That's why a small increase in revenue can lead to a massive explosion in net income.
That makes sense. Once you pay for the diesel and the labor, the rest is gravy. But usually when I look at miners, especially after a big growth phase, I see the hangover.
The debt.
I see a mountain of debt used to finance all that heavy equipment and exploration. Is Hecla sitting on a massive credit card bill that's about to come due?
And that is the second pillar of the bull case. And honestly, for the long-term holder, it might be more important than the earnings beat.
Really?
For a long time, the mining sector was practically uninvestable for conservative funds because of that exact debt problem. Hecla has flipped that script. They have used this cash flow windfall to aggressively pay down debt.
I saw a note in the research about them being net debt neutral. Can we break that down? Does that mean they have zero debt, or is it some kind of accounting magic?
It's a bit of financial terminology. but it's solid. It doesn't mean they have literally zero debt on the books. It means their cash on hand and liquid assets are equal to or greater than their total debt.
Okay.
Their net leverage dropped from 1.8 times down to just 0.3 times. In the corporate finance world, 0.3 is basically zero.
It's nothing.
It means they could write a check tomorrow and clear their obligations if they really had to.
Which means they aren't bleeding cash on interest payments anymore. In a high-rate environment like we've had, that service cost can be a killer.
Exactly. This deleveraging saved them about $15 million in annual interest expenses. That is $15 million that doesn't go to the bank. It goes straight to the bottom line.
Or back into the business.
Or into dividends, or into exploration. It turns the company into a fortress. And when you are in a cyclical industry like mining, having a fortress balance sheet is the difference between surviving a downturn and going bankrupt.
I like that term, fortress balance sheet. It implies safety. And that pairs well with the other big selling point here, which is the geography. We talk a lot about geopolitical risk on this show. We've seen mines get nationalized in South America, tax regimes change overnight in Africa. It feels like every week there's a new headache for global miners.
There always is.
Hecla seems to be playing a different game entirely.
They are playing the North American moat game. This is a massive differentiator. While their competitors are dealing with labor strikes in Mexico or political instability in Peru, Hecla operates almost exclusively in the United States and Canada.
So we're talking Idaho, Alaska?
Idaho, Alaska, the Yukon, Quebec. These are Tier 1 jurisdictions.
But isn't Tier 1 just industry jargon for expensive to operate? I mean, labor in Idaho or Quebec costs a lot more than labor in a developing nation.
It does, but you are paying for the rule of law. You are paying for certainty. Hecla is the oldest U.S.-based mining company on the New York Stock Exchange, 135 years old. That history actually counts for something. Permitting is the silent killer in the mining industry. You can find $1 billion of gold, but if you can't get the permit, it's worth zero.
Right.
Being established for over a century gives Hecla a level of institutional knowledge and regulatory relationships that a new player just cannot replicate.
So they have the safety of the jurisdiction.
Yeah.
But let's talk about the assets themselves. Because you can be in a safe jurisdiction and still have a terrible mine that doesn't make any money.
And that brings us to the crown jewel, Greens Creek. This mine, located in Alaska, is frankly a freak of nature in the best possible way.
Oh, yeah?
It has what we call negative cash costs after byproduct credits.
Okay, hold on. Negative cash costs. That sounds like voodoo economics. How can it cost negative money to run a mine? Explain that to the listener who might be thinking this sounds like a scam or some Enron accounting.
It does sound too good to be true, doesn't it?
It really does.
But here are the mechanics of it. Greens Creek is a polymetallic mine. They don't just find silver, they find significant amounts of zinc, lead, and gold in the same rock.
Oh, okay.
They sell those other metals, the zinc and the lead, on the open market. The revenue from those byproducts, it's so high that it covers the entire operating cost of the mine.
The whole thing.
The labor, the fuel, the electricity, everything.
So conceptually, the zinc pays the electric bill and the gold pays the staff.
Exactly. So by the time they get to the silver, it has effectively cost them nothing to produce, or mathematically they are being paid to produce it.
That's incredible.
This provides insane competitive advantage. If the price of silver drops to $10, which, knock on wood, it won't.
Let's hope not.
Hecla is still making money at Greens Creek while almost every other primary silver miner on the planet goes bust.
That is the definition of a moat. Low costs plus safe jurisdictions. It sounds bulletproof.
Pretty close.
But there's another element boosting the stock right now that has nothing to do with rocks or geology, right? We have a market mechanics situation playing out.
We do. It's a forced buying event. Hecla is being added to the S&P Midcap 400 index.
And why does that matter so much? Is it just prestige? Does it just look good on the website?
It's liquidity. When a company joins an index like the S&P Midcap 400, it triggers a chain reaction.
Right.
Every passive fund, every ETF, and every pension fund that tracks that index must buy the stock to rebalance their portfolio. They don't have a choice.
No analysis, just buy.
They don't analyze the PE ratio. They don't look at the drill results. They just buy because the algorithm tells them to. It creates a floor of buying pressure that is completely price insensitive.
So you have fundamental buying from growth investors who love the earnings and robotic buying from passive funds. That explains the momentum. But despite this run-up, we're talking 300% in a year. I was reading some reports that claim it's still cheap. How is that possible?
It depends on your time horizon and your silver price assumptions. If you look at discounted cash flow models or DCF,
The BCF model.
which try to calculate the intrinsic value of all that future silver coming out of the ground over the next 20 years, some analysts are pegging the value around $40 or $41 per share.
And we're trading around 25. So that implies there's still another 40% upside left in the tank, even after this monster rally.
If, and this is a big if, the silver prices hold and if they hit their production targets, the math supports a higher price, assuming the supercycle continues.
Okay, that all sounds incredible.
Yeah.
Record revenue, fortress balance sheet, negative costs at Greens Creek, and passive funds forced to buy the stock. Sounds like a slam dunk.
It's a strong case.
But I am the guy who has to ask the uncomfortable questions. My wallet gets nervous when I see a chart go vertical.
As it should.
Let's pivot. Let's play devil's advocate.
Yeah.
What happens if this goes wrong? Because when a stock goes up 300% in a year, the air gets pretty thin up there.
It does. And we have to address the elephant in the room, the valuation.
It's a nosebleed, isn't it? I looked at the metrics this morning and I thought there was a typo.
It is elevated, to put it mildly. Right now, Hecla is trading at a price-earnings ratio, or PE, hovering between 65 and 80 times earnings, depending on your forward estimates.
Whoa, 80 times. Just for context, we usually see tech high flyers like NVIDIA or Tesla trading at those multiples during a boom.
Right.
What is the industry average for a company that digs holes in the ground?
The industry average for metals and mining is closer to 26 times.
26.
So let that sink in. You are paying a massive premium. You are paying 3 times the industry average for every dollar of Hecla's earnings. You are effectively paying for the next 80 years of earnings today.
That is priced for perfection. That implies the market expects everything to go right forever. No strikes, no cave-ins, no price drops.
Precisely. The risk here is what we call multiple compression. This is the silent killer of growth stocks. If silver prices stall, they don't even have to crash, they just have to stop going up. Or, if the market sentiment shifts just a little bit, investors might decide they aren't willing to pay 80 times earnings anymore.
Maybe they only want to pay 40.
Maybe they only want to pay 40 times. Even if the company makes the exact same amount of money, the stock price gets cut in half.
And Hecla is a pure play. They don't have a diversified business unit selling software or cloud services. They sell silver and gold.
That's it.
If the silver supercycle thesis turns out to be wrong, they have nowhere to hide.
That's the commodity dependency risk. They are a price taker. A company like Apple sets the price of the iPhone. Hecla does not set the price of silver.
The market does.
Yes, the market does. If the Federal Reserve stays hawkish, keeps rates high to crush inflation, the demand for silver as a hedge could evaporate. If that happens, Hecla's revenue drops, and that 80x PE ratio starts to look terrifying.
And let's not forget, mining is actually hard work. It's not just spreadsheets. You have to move earth in the Yukon.
Right.
I've never been to the Yukon in January, but I assume it's not an easy place to work.
It's incredibly difficult. It is the spreadsheet versus the shovel problem. We've seen cost overruns in this industry time and time again. Hecla has newer expansions like Keno Hill in the Yukon.
Why?
Ramp-ups are notoriously tricky. You have inflation impacting labor costs, fuel costs, equipment costs.
So even if silver prices stay high, if the cost to get it out of the ground goes up at Keno Hill, those margins get squeezed.
And remember, with the stock up 300%, the market has priced in a flawless execution.
Right. Any bad news is amplified.
Any bad news. A missed production target, a slight delay due to weather, a minor cost overrun could trigger a sharp sell-off. The expectations are so high that good news might be treated as bad news because it wasn't great news.
So we have a clear tension here. On one side, a fundamental step change and a silver supercycle that suggests this is the best asset in the class.
Right.
On the other, a valuation that leaves absolutely no room for error. So for the listener holding this stock or thinking about buying it, we can't just sit on our hands. What are the triggers? What are we watching in the next 30 days?
We have a very active calendar. The first date to circle in red ink is Monday, January 26, 2026.
That's the investor day, right?
Yes, and it's a big one. Hecla is celebrating its 135th anniversary by ringing the closing bell at the NYSE. Now, that's a nice photo op, and it gets them on CNBC.
Sure.
But for investors, the substance will be in the presentation decks. We are expecting updates on their long-term strategy and their capital allocation.
By capital allocation, you mean?
Yeah.
What are they going to do with all this cash?
Exactly. Are they going to increase dividends? Are they going to buy back shares to support the price? Or are they going to spend it on more exploration?
Okay.
But the most critical thing to listen for is guidance on the Keno Hill ramp-up.
If they come out on January 26 and say Keno Hill is ahead of schedule and under budget, that could be the fuel for the next leg up.
That validates the ADX multiple. But if they hint at delays or if they mention that the per ounce cost is creeping up, watch out below.
It's a binary event.
It really is.
Okay, so January 26 is the first hurdle. What's next?
The second catalyst is Q4 earnings, which are expected in early February. The market is expecting another beat.
They have to beat. At this valuation, meeting expectations isn't enough.
Correct. They need to show that they are maintaining those high margins we talked about earlier. But I'd argue the most important metric to watch in that earnings report is free cash flow generation. Net income can be manipulated with accounting. Free cash flow is truth. Cash is king. If they show strong cash generation, it justifies the valuation because it proves the business is printing money.
And the third catalyst?
Macro data.
Right.
We have to look outside the company at the CPI prints and the Fed meetings.
Right.
We had the January 13 CPI data recently, but the market is constantly looking forward to the next Fed decision.
This goes back to the why of the silver supercycle.
Right. Silver is two things. It's an industrial metal for solar panels and EVs, and it's a monetary metal hedge against inflation and currency debasement.
Two different theses.
If inflation data stays hot, silver acts as a hedge. When silver flies, Hecla flies. It is high beta. It moves faster and harder than the metal itself.
So if you're betting on Hecla, you're implicitly betting on inflation staying sticky. You're betting against the Fed successfully killing inflation.
In many ways, yes. Or you are betting on the green energy transition. Remember, you cannot build a solar panel without silver.
Right.
You cannot build a sophisticated EV without silver contacts. That industrial demand creates a long-term floor. But in the short term, over the next 30 days, the stock price will dance to the tune of inflation expectations and Fed policy.
Okay, let's bring this home. We've looked at the massive revenue jump, the fortress balance sheet, the negative cost magic at Greens Creek, and that scary ADX PE ratio. So what's the lowdown? How should our listener think about this right now?
If you step back and look at the big picture, Hecla Mining has positioned itself as the premier vehicle for silver exposure in North America.
Oh.
They have done the hard work of fixing the balance sheet. They have the assets. But as an investor, you have to acknowledge that you are paying a premium price for a premium asset.
It's like buying the best house in the best neighborhood, but buying it at the absolute peak of the housing market in a bidding war.
That's a great analogy. If you believe in the silver supercycle, if you believe silver is going to $50 or $100 an ounce because of solar demand and currency debasement,
Then you buy.
then Hecla is arguably the safest, most leveraged way to play that thesis. You swallow the high PE because the growth potential is exponential.
But if you're just chasing momentum,
If you're just chasing the chart because your neighbor told you about it, you need to be careful. Volatility is guaranteed here. A 300% run-up rarely happens in a straight line forever.
right,
You have to be ready for 20% drawdowns.
that's the trade-off. You're paying for quality, but you're paying a lot. If you believe in the green energy transition, this is the stock to watch. It's the only safe way to play the $150 silver thesis that doesn't involve buying heavy coins and burying them in your backyard, but you've got to have a stomach of steel.
Well said. It's a high-conviction play for a high-conviction investor.
And that's where we're going to leave it for today. A massive thank you for tuning in to the Easy Money Show. We hope this helped you make sense of the madness in the mining sector.
There is always more to learn, but hopefully the picture is a little clearer now.
Make sure you subscribe and smash that like button so you don't miss our next breakdown. We'll catch you on the next one.
See you then.